Hey everybody, welcome back to the channel. Today we're diving into one of the most essential skills for any investor, how to spot undervalued stocks. Finding undervalued stocks is like finding hidden gems in the market. Stocks that are trading below their true worth and have the potential to deliver massive returns. But how do you find these hidden gems? In this video, I will walk you through three key concepts: the PE ratio, intrinsic value, and the margin of safety. I'll also show you real-life examples and formulas to spot undervalued stocks today. So let's get started. The first tool in your undervalued stock toolkit is the PE, or price to earnings ratio. This is one of the most widely used metrics in investing, and for good reason. It tells you how much you're paying for a company's earnings. The formula for the PE ratio is simple. PE ratio is equal to the stock price divided by earnings per share, the EPS. For example, a company's stock trades at $50 and its earnings per share EPS is $5. The PE ratio would be 50 divided by 5 is equal to $10. A PE ratio of 10 means paying $10 for every $1 of earnings. Generally, a lower PE ratio suggests the stock might be undervalued, while a higher PE ratio could mean it's overvalued. But here's the catch. The PE ratio isn't a one-size-fits-all metric. Different industries have different average PE ratios. For example, tech companies often have higher PE ratios because of their growth potential, while utility companies tend to have a lower PE ratio because they're more stable but slower growing. So, when using the PE ratio, always compare it to the industry average and the company's historical PE ratio. If a stock's PE ratio is significantly lower than its peers, it might be undervalued. To show you what I mean, let's compare the PE ratios of three major tech companies. So here is a table with their current PE ratios for Apple, Microsoft, and Alphabet, Google. As you can see, all three companies have PE ratios in the 30s, which is typical for the tech industry. This reflects their high growth potential and investors' confidence in their future earnings. Now let's compare this to the consumer goods sector, which is known for being more stable but slower growing. Here's a table for three well-known consumer goods companies: Procter & Gamble, Coca-Cola, and PepsiCo. So when using the PE ratio, always compare it to the industry average and the company's historical PE ratio. If a stock's PE ratio is significantly lower than its peers, it might be undervalued. For example, if a tech company has a PE ratio of 20 while its competitors are at 30, that could be a sign it's undervalued and worth further research. Now that you understand the PE ratio, let's talk about the intrinsic value of a stock. Intrinsic value is the true worth of a company based on its fundamentals, not just its current stock price. One of the most popular ways to calculate intrinsic value is using the discounted cash flow method. Here's how it works. So first, estimate the company's future cash flows. Discount those cash flows back to the present value using a discount rate, usually the company's cost of capital. Add up the present values to get the intrinsic value. The formula looks like this. Intrinsic value is equal to cash flow given in a year divided by 1 plus the discount rate to the power of 1 plus the cash flow given in a year for year 2 divided by bracket 1 plus the discount rate to the square root of 2, and so on, where CF is equal to cash flow in a given year, R is equal to the discount rate, and N is equal to the number of years. Let's break this down with an example. Suppose a company is expected to generate the following cash flows over the next 5 years. In year 1, 100 million, year 2, 120 million, year 3, 140 million, year 5, 160 million, and year 5, 180 million. And let's assume the discount rate is 10%. Using the DCF formula, the intrinsic value would be 100 million divided by 1.1 plus 120 divided by 1.21 plus 140 divided by 1.33 plus 160 divided by 1.46 and 180 divided by 1.61, which simplifies to $516.8 million. If the company has 50 million shares outstanding, the intrinsic value per share would be 516.8 divided by 50, which is equal to $10.34 per share. If the stock is trading below 10.34, it might mean that it's undervalued. If it's trading above, it could be overvalued. Now that you've calculated the intrinsic value, it's time to apply the margin of safety. This concept was popularized by Benjamin Graham, known as the father of value investing. The margin of safety is the difference between the intrinsic value of a stock and its market price. It's your buffer against errors in your calculations or unexpected market downturns. The formula for the margin of safety is margin of safety is equal to the intrinsic value take away the market price divided by the intrinsic value again. For example, you've calculated a stock's intrinsic value at $50, currently trading at $40. The margin of safety would be 50 take away 40 divided by 50, which is equal to 20%. A 20% margin of safety means that you're buying the stock at a 20% discount of its true worth. The higher the margin of safety, the lower the risk. Benjamin Graham recommended a margin of safety of at least 20 to 30%. This ensures you're still getting a good deal even if your calculations are still off. Let's put all of this into practice with a real-life example. Apple, AAPL. So let's start with the PE ratio. Apple stocks is trading at around $210 right now, with an EPS of $6, so its PE ratio is 210 divided by 6, which is equal to $35. Compared to the tech industry average PE ratio of around 25, Apple's PE ratio is slightly higher, but let's dig deeper. The intrinsic value using a simplified DCF model, let's estimate Apple's intrinsic value. Suppose Apple is expected to generate $100 billion in free cash flow next year, growing at 5% annually for the next 5 years. Using the discount rate of 8%, the intrinsic value would be 100 divided by 1.8, 105 billion divided by 1.17, and so on, which simplifies to $437.9 billion. If Apple has 16 billion shares outstanding, the intrinsic value per share would be $27.37 per share. But wait a minute, that doesn't sound right. Apple's trading currently at $210, but the intrinsic value calculation suggests it's worth $27.37. What's going on here? This is an excellent example of why the DCF model has its limitations. For high growth companies like Apple, a simple 5-year DCF model might not capture their long-term potential. That's why using multiple valuation methods and adjusting your assumptions is essential. So for the margin of safety for Apple, if we adjust our intrinsic value estimate to 180 based on more optimistic growth assumptions, the margin of safety at a 210 stock price would be 180 take away 210 divided by 180, which is equal to negative 16%. A negative margin of safety suggests the stock might be overvalued, but again, this depends on your assumptions. The key takeaway is to research and use multiple valuation methods. To spot undervalued stocks, you can combine all three tools, the PE ratio, intrinsic value, and margin of safety. Here's how. Start with the PE ratio. Identify stocks with lower PE ratios than the industry average. Calculate the intrinsic value using the DCF or other valuation models to estimate the stock's worth, and then apply the margin of safety. Only buy stocks trading at a significant discount to their intrinsic value. By following this process, you'll be able to identify undervalued stocks with strong potential for growth. And there you have it, how to spot undervalued stocks. We covered the PE ratio, intrinsic value, and margin of safety, and even walked through a real-life example with Apple. If you found this video helpful, give it a thumbs up and let me know in the comment what your favorite undervalued stock is and why. Remember, investing is a journey. The more you learn, the better your decisions will be. Thanks for watching, and I'll see you in the following video. Thank you.